Hey everyone, and welcome back to the Safe Simple Sound Podcast Tax Edition. I'm your host, Alex, and I'm thrilled to have you join us today as we tackle a topic that's crucial for so many of you: understanding the qualifying child for tax purposes. At Safe Simple Sound, we are all about helping you seize financial control, and a big part of that is making sure you are correctly handling important parts of tax filing. Today's episode is based on a detailed breakdown of IRS Publication 17, specifically the section explaining who qualifies as a qualifying child when you're claiming a dependent. This is all about maximizing your tax benefits and ensuring you're filing accurately, avoiding any potential headaches down the road. This isn't just about checking a box on a form. It's about potentially unlocking significant financial benefits like the child tax credit, the earned income credit, and even determining if you qualify for head of household filing status. The financial impact can be huge. We also want you to avoid inadvertently missing those benefits, or even worse, incorrectly filing. Publication 17 really highlights a few key things. First, it emphasizes that there are 5 very specific tests a child must meet to be considered a qualifying child. It's not as simple as just saying, "Yep, that's my kid." Second, it dives deep into the complexities that arise for divorced or separated parents, who gets to claim the child, and what paperwork is involved. That's a huge area of confusion for many. And finally, the rules also have tiebreakers. Did you know that in some cases, multiple people might technically be able to claim the same child? The IRS has tiebreaker rules for that, and we'll break them down. To make sure we cover everything in a clear, simple, and sound way, here's how we'll structure today's episode. First, we'll lay the groundwork with an introduction to the qualifying child concept. We'll define exactly what qualifying child means and why it's so important to your overall tax strategy. We'll also look at the difference between a qualifying child and a qualifying relative. Next, we'll tackle the first 3 of the 5 tests. The 5 tests: relationship, age, and residency. We'll explore who qualifies under the relationship test, the different age limits, and what counts as residency, including those tricky situations like temporary absences for school or medical care. Then, we'll move on to the remaining 2 tests in the 5 tests: support and joint return. This is where we'll get into the nitty-gritty of calculating whether the child provided more than half of their own support, and when a child filing a joint return might disqualify them. Think a child buying their own car counts as their own support? We'll answer that. After that, we'll address those often confusing situations in special considerations: divorced, separated parents, and tiebreakers. We'll untangle the rules around custodial versus non-custodial parents, Form 8332, and what happens when more than one person tries to claim the same dependent. Finally, we'll wrap up with SSN requirements, claiming benefits, and conclusion. We'll cover the crucial Social Security number requirement for claiming certain credits, explore alternatives like the credit for other dependents, and, most importantly, reiterate how all this can help you reap the benefits of, well, not compound growth in this exact case, but certainly of smart tax planning. So, get ready to take some notes because we're about to make the complex world of qualifying child rules safe, simple, and sound. Let's dive in. Now, this might sound like a dry, technical term, but trust me, understanding the qualifying child definition is crucial for accurate tax filing. It's the gateway to some pretty significant tax benefits, like the child tax credit, the earned income credit, and even potentially qualifying for head of household filing status. These aren't small potatoes, folks. We're talking about potentially hundreds, even thousands of dollars in tax savings. So, what is a qualifying child exactly? It's more than just a kid you're responsible for. The IRS has specific rules, a series of tests to determine if someone qualifies. Think of it like a recipe. You need all the right ingredients in the right amounts to get the desired result. Misunderstanding these rules can lead to either missed tax benefits or worse, penalties from the IRS for incorrectly claiming someone. No one wants that. It's important to understand that there are 2 main ways you can claim someone as a dependent. The IRS identifies these as a qualifying child or a qualifying relative. Today we are focusing on the qualifying child tests. We'll save relatives for another day. Now, before you start mentally listing off every child in your life, let's get one thing clear. There are 5 key tests a person must meet to be your qualifying child. We'll cover each of these in detail in upcoming segments, but for now, here's a sneak peek. We've got the relationship test, the age test, the residency test, the support test, and finally, the joint return test. Each one is like a hurdle your potential dependent needs to clear. Let's paint a picture here. Imagine you're supporting your 16-year-old niece who lives with you. You might think she automatically qualifies as your dependent. But what if she earned a significant amount of money from a part-time job? What if she filed a joint tax return with her boyfriend? These factors could impact whether she meets the support or joint return tests, and therefore whether you can claim her. Or consider a divorced couple. Who gets to claim their child as a dependent? It's not always straightforward, and the rules can get pretty intricate. The financial impact of getting this right is huge. Let's say you incorrectly claim your niece, and the IRS later determines she doesn't qualify. You might have to repay any tax credits you received, plus interest and potential penalties. Ouch! On the flip side, if you don't claim a child who does qualify, you're leaving money on the table, money that could be used for your family's needs. For all the nitty-gritty details, your best friend is IRS Publication 17. This is the IRS's official guide to individual income taxes, and it has a whole section dedicated to dependents. It's not exactly light reading, but it's the definitive source. Think of it as the tax law encyclopedia. We'll be referencing it throughout this series, and I highly recommend you bookmark it or download a copy. So, here's your homework, your call to action for this segment. Review your current tax situation and consider who you might be able to claim as a dependent. Maybe it's your own children, a stepchild, a foster child, or even a younger sibling or grandchild living with you. Keep these potential dependents in mind as we go through the 5 tests in our next few segments. We are going to break them down into smaller, digestible chunks, because up next we're tackling the first 3 tests: relationship, age, and residency. The key is that all of these tests must be passed in order for the individual to qualify. We'll explore what counts as a close relative, how old is too old to be a qualifying child, and what it really means to live with someone for more than half the year. Stay tuned. First up, the relationship test. Think of it like a family tree. To be your qualifying child, the person must be your son, daughter, stepchild, or an eligible foster child. It also includes siblings, your brother, sister, stepbrother, or stepsister, and it extends to descendants of any of those individuals. So your grandchild, niece, or nephew could also qualify. Let's say you're raising your younger sister because your parents are no longer able to. She passes the relationship test. Or maybe you've legally adopted a child. They absolutely fit the definition. Same goes for a foster child officially placed with you by an authorized agency or court. The key here is the legal or biological connection. Your best friend's kid, no matter how much time they spend at your house, doesn't meet this test. Next, we have the age test. This one has a few layers. Generally, the child must be under 19 at the end of the tax year and younger than you or your spouse if you're filing jointly. So if your child turned 19 on December 31st, they generally fail the age test for that year. But there are 2 important exceptions. The age limit goes up to 24 if the child is a full-time student for at least part of 5 calendar months during the year. Think college students. They're often still dependents, even if they're a bit older. Let's say you support your 22-year-old daughter, who's a full-time college student. She absolutely passes this. The other exception is for individuals who are permanently and totally disabled, regardless of their age. In this case, the age limit doesn't apply. Also, remember that younger than you rule. If you're 23 and your brother is 22, he's not your qualifying child, even if he is a student. But if you and your spouse file jointly and your spouse is 25, then that 22-year-old brother is your qualifying child, so long as all the other tests are met. Finally, for this segment, let's tackle the residency test. This one seems simple, but it has some nuances. The child must have lived with you for more than half of the year. That's more than 6 months, folks. Now, life happens, right? Kids go to college, They might take a long summer vacation with their grandparents, or maybe there's a medical situation requiring treatment elsewhere. These are considered temporary absences, and the IRS is pretty understanding. Temporary absences don't break the residency test. For example, your child attending university out of state, but still considers your house their primary home, still passes the residency test. The key is that the intent is for your home to be the child's main home. There are also a few other exceptions for this test. If a child was born or passed away during the year, they only had to have lived with you for more than half of the time that they were alive. If you adopted a child during the year, or if a child was lawfully placed with you, the same thing applies. They only need to have lived with you for more than half of the time since the placement. The Publication 17 also brings up the difficult topic of a kidnapped child. These children may still meet the residency test, but for specifics, check out Publication 17. Okay, that's a lot of information, so let's recap. We've covered the relationship, age, and residency tests for determining if someone is your qualifying child. We learned who qualifies under the relationship test, the age cutoffs and exceptions for students and those with disabilities, and the residency requirement, including how temporary absences are handled. Here's your action item. Take a few minutes to think about anyone you might be claiming as a dependent. Do they meet the relationship, age, and residency tests? Jot down any relevant dates like birthdays, when they started living with you, or any periods of temporary absence. Having this information organized will be incredibly helpful. We've just covered the residency test for determining if someone qualifies as your dependent child. Now, let's move on to two crucial tests that often trip people up: the support test and the joint return test. These can get a little tricky, but we're going to break them down step by step so you can confidently figure out if they apply to your situation. Think of it this way. Claiming a dependent is like getting a discount on your tax bill, but the IRS has specific rules, these tests, to make sure you're actually entitled to that discount. We've already discussed relationship, age, and residency. Now we focus on the financial side of things. First up, the support test. This one is all about who's footing the bill for the child's living expenses. The basic rule is this: the child cannot have provided more than half of their own support for the year. Sounds simple enough, right? But support is a broader term than you might think. We're not just talking about pocket money here. Support includes things like housing, fair market rental value if they live with you, food, clothing, education, medical and dental care, recreation, transportation, and even things like summer camp or extracurricular activities. Essentially, all the costs associated with raising a child. Now, a question I often get is, what are some common expenses that parents might incorrectly exclude when calculating support? People often forget about the big-ticket items. Think about health insurance premiums, even if you're paying them through your employer, or the fair rental value of your home. If your child lives with you, a portion of your mortgage or rent counts towards their support. Also, don't forget things like utilities, groceries, and even that family vacation to Disneyland, all part of the support equation. The IRS actually provides a helpful resource, Worksheet 3.1 in Publication 17, to help you calculate support. We won't go through it line by line here, but I highly recommend checking it out. It provides a structured way to list out all the potential expenses and see who, you or the child, provided more than half. Here's a key consideration that often surprises people, taken directly from the IRS guidelines. If your child owns a car, even if they bought it, the expenses associated with that car, things like gas, insurance, and repairs, are included in their support, not yours. Let's say your 17-year-old son works part-time and uses his earnings to buy a used car for $4,500. He also pays for his own gas and insurance. Meanwhile, you provide $4,000 for his food, clothing, housing, and other expenses. In this case, your son has provided more than half of his own support, $4,500 plus gas and insurance, versus your $4,000. Even though you're covering a lot of his basic needs, that car purchase tips the scales, and he would not meet the support test. Now let's move on to the joint return test. Generally, a child cannot be your qualifying child if they file a joint return with their spouse. Marriage changes things, legally and financially. The IRS generally assumes that a married couple is a separate financial unit. However, there's a very important exception. If your child and their spouse file a joint return solely to claim a refund of withheld income tax or estimated tax paid, then the joint return test doesn't disqualify them. Here's an example. Let's say your 18-year-old daughter got married last year. She and her husband both had part-time jobs and taxes were withheld from their paychecks. They file a joint return simply to get that withheld money back, a refund. Because they're only filing to get a refund and they aren't claiming any other credits or deductions, they could still meet the joint return test, and you might still be able to claim her as a dependent, assuming she meets all the other tests, of course. But let's change the scenario. Let's say your daughter and her husband file jointly, and they also claim the American Opportunity Tax Credit for college expenses. In this case, the exception doesn't apply. They're filing for more than just a refund, so they would not meet the joint return test, and you could not claim her. Why is this joint return test in place? Think of it this way. If a married couple is filing a joint return and claiming credits and deductions, they're essentially declaring themselves as a financially independent unit. The refund exception is there for simple situations where they're just getting back money that was already theirs. So, to recap, we've tackled two big tests. Support test. Did the child provide more than half of their own support? Remember to include all relevant expenses, and don't forget about things like a car owned by the child. Joint return test. Did the child file a joint return? If so, was it only to claim a refund of withheld taxes, or did they claim other credits or deductions? For your call to action this week, I want you to do two things. First, start calculating or at least estimating the support provided to and by any potential dependent you're considering claiming. Really think about all those expenses. Second, if the potential dependent is married, find out if they filed a joint return, and crucially, why they filed it. Was it just for a refund, or were they claiming other tax benefits? Having this information is absolutely critical for determining if you meet these two tests. We've just wrapped up a discussion on the support and joint return tests for claiming a qualifying child. Now, things can get a little more complicated, and I mean IRS-level complicated, when we're talking about divorced or separated parents. So let's dive into the special considerations and, crucially, the tiebreaker rules that come into play. This is where understanding the fine print can make a big difference in your tax return and potentially save you some serious headaches. The main thing to wrap your head around is this. Who gets to claim the child for tax benefits like the child tax credit? It seems like it should be straightforward, but with different households and sometimes conflicting agreements, the IRS had to lay down some very specific rules. First, the general rule. In most cases, it's the custodial parent who claims the child. That's the parent the child lived with for the greater number of nights during the year. Think of it like this. Who's packing the school lunches most often? Who's handling the bedtime routine? That's usually your custodial parent. For example, Jenny and Ben are divorced. Their daughter, Chloe, lives with Jenny for 200 nights of the year and Ben for 165. Jenny is the custodial parent. But, and this is a big but, there's an exception. The custodial parent can release their right to claim the child to the noncustodial parent. They do this using IRS Form 8332, or a similar written statement. It's essentially saying, okay, you can claim the child tax credit this year. Why would a parent do this? Maybe it's part of their divorce agreement, or maybe the non-custodial parent's tax situation makes it more beneficial for them to claim the credit. Remember, though, the Form 8332, or familiar statement, only gives the non-custodial parent the right to claim the child tax credit, the additional child tax credit, and the credit for other dependents. For example, using our previous example, Jenny completes Form 8332. Now, Ben may claim Chloe for the purposes of the child tax credit, the additional child tax credit, and the credit for other dependents. Now, for those of you with divorce decrees or separation agreements that date back to before 1985, there's a different set of rules. If that older agreement says the non-custodial parent can claim the child and that parent provided at least $600 in support for the child during the year, and the decree hasn't been modified, then the non-custodial parent can claim the child. This is a bit of a legacy rule, so it doesn't apply to most modern divorces. Okay, what about situations where custody is truly shared, 50-50? In these cases, the IRS looks at adjusted gross income, or AGI. The parent with the higher AGI is considered the custodial parent for tax purposes. This is purely for tax purposes, and the custody for legal purposes is still 50-50. Now let's talk tiebreaker rules. These come into play when, for whatever reason, more than one person could potentially claim the same child. This can get messy, so listen up. Parent versus non-parent. If one person is the child's parent and the other isn't, say, a grandparent, the parent gets to claim the child. Pretty straightforward. Parents filing jointly. If the parents file a joint return, they obviously claim the child together. No tiebreaker needed. Parents filing separately, but not divorced separated. If the parents don't file jointly and the child lived with both of them, the child is treated as the qualifying child of the parent the child lived with for the longer period. If it's exactly the same amount of time, it goes back to the AGI. The parent with the higher AGI gets to claim the child. No parent can claim. If no parent can claim the child, maybe the child is living with a grandparent or other relative, then the person with the highest AGI among those who could claim the child gets to do so, provided that no parent is eligible to claim the child as a dependent. The whole point of these tiebreaker rules is to make sure that only one person claims the child for tax benefits. You can't split the child tax credit or both claim head of household status based on the same child. The IRS is very clear on that. Why are these rules so complex? Well, think about it. Family situations can be complex. Divorces can be messy. The IRS is trying to create a system that's as fair as possible while also preventing double dipping and fraud. The potential pitfalls: misunderstanding the rules, incorrectly claiming a child, and facing potential penalties or having to amend your tax return. It's definitely worth taking the time to get this right. So here's your call to action. If you're divorced or separated, take a good look at your divorce decree or separation agreement. See what it says about claiming the child for tax purposes. If Form 8332 is relevant to your situation, make sure you either obtain it from the other parent or provide it to them, depending on your agreement. And finally, if the tiebreaker rules might apply to you, take some time to understand them and how they affect your specific circumstances. It's a lot to take in, I know, but understanding these rules can save you a lot of trouble down the line. Next up, we'll be discussing the SSN requirements for claiming a child and how to actually claim those valuable tax benefits. Stay tuned. Now let's dive into the practical side, actually claiming those valuable benefits and the crucial documentation you'll need. We're talking about Social Security numbers, the child tax credit, and some alternative options if your situation doesn't quite fit the standard mold. First and foremost, let's talk about the SSN requirement. This is a big one. To claim the child tax credit or the additional child tax credit, your qualifying child must have a Social Security number that's valid for employment. And this SSN needs to have been issued before the due date of your tax return, including any extensions you might have. Why is the IRS so strict about this? Well, it's primarily to prevent fraud and ensure that these benefits are going to the right people. Think of it like a secure lock on a valuable treasure chest. The SSN is the key. Without it, you can't access those credits. It's about verifying identity and making sure the system is fair for everyone. Now, there's one heartbreaking but important exception to this rule. If a child was born and sadly passed away within the same tax year, and therefore didn't have a chance to get an SSN, you can still claim certain benefits. In this case, you'll need to attach a copy of the child's birth certificate, death certificate, or hospital records to your tax return. This documentation proves the child was born alive, even if they were only with us for a short time. It's a sensitive situation, but the IRS has made provisions to acknowledge this. But what if your child doesn't have a valid SSN for employment, and the exception above doesn't apply? Don't despair. There's still an option. You might be able to claim the credit for other dependents, or ODC. This credit is worth up to $500, and it's designed for dependents who don't meet the SSN requirement for the child tax credit. It's not as much as the full child tax credit, but it's still a significant benefit that can help offset your tax liability. Think of it as a smaller but still helpful key to a slightly different treasure chest. So let's recap the incredible benefits you can unlock when you do have a qualifying child with a valid SSN. We're talking about the potential for the child tax credit, which can significantly reduce your tax bill. You might also be eligible for the Earned Income Credit EIC, which is especially helpful for lower to moderate income families. And having a qualifying child can also allow you to file as head of household, which usually gives you a lower tax rate and a higher standard deduction than filing as single. There's also the credit for child and dependent care expenses, if you paid for someone to watch your child so that you could work. All of these benefits add up. It's like getting a series of discounts and bonuses just for being a parent or guardian. If you realize at any point you have previously made an error in claiming a dependent, don't panic. File an amended tax return using Form 1040-X. It is better to correct the issue yourself before the IRS discovers the error. Finally, remember, this is all based on the information in IRS Publication 17. That's your go-to resource for all the official details, and it's updated every year. And as always, I strongly recommend consulting with a tax professional. They can look at your specific situation, answer your individual questions, and make sure you're claiming everything you're entitled to. Tax laws can be complex, and a little personalized advice can go a long way. So, your homework for this week, if you're a parent or guardian, is to gather the necessary documentation for your potential qualifying child. This means tracking down their Social Security card, birth certificate, if applicable, and any other relevant records. Then, either use tax software, which often guides you through these questions, or schedule a consultation with a tax professional. The goal is to file your tax return accurately and claim all the benefits you deserve. And that's a wrap on our deep dive into the world of the qualifying child. I hope you found this episode as helpful and, dare I say, illuminating as I did. We really unpacked a lot today, didn't we? We started by understanding the basic qualifying child definition and why it's so critical for accurate tax filing, especially when it comes to claiming those valuable benefits like the child tax credit and the earned income credit. Remember, getting this right can have a significant impact on your bottom line. We then systematically worked through those 5 key tests: relationship, age, residency, support, and joint return. We tackled some tricky questions, like how a car owned by your child impacts the support test and the exceptions to the residency test for temporary absences. And of course, we spent a good chunk of time on the special considerations for divorced or separated parents. This is often where things get really complicated, so I hope we clarified the rules around custodial and non-custodial parents, Form 8332, and those all-important tiebreaker rules. That section alone could save some of you a lot of headaches. Finally, we took a look at the Social Security number SSN requirements for certain credits. And even if your child may not qualify as a qualifying child, there is still hope with the Credit for Other Dependents ODC. The big takeaway here? Don't just assume. The IRS has very specific rules, and understanding them is key to maximizing your tax benefits and staying compliant. Remember, IRS Publication 17 is your friend. And of course, so is the Safe, Simple, Sound podcast. I want to sincerely thank you for tuning in and being a part of the Safe, Simple, Sound community. Your financial well-being is what drives us, and we're here to help you seize financial control, one tax rule at a time. If you found this episode helpful, please take a moment to subscribe to the podcast, leave us a review, and share it with anyone who might benefit, especially other parents navigating these tax waters. And be sure to check out our show notes for a link to the original article and other helpful resources. Stay informed, stay empowered, and keep making safe, simple, and sound financial choices. This is Alex, signing off.